In case you're wondering, I'm back in the States and down a brick wall. A few days ago, the federal government released a Blockbuster GDP report. So good, in fact, it sent stocks crashing before Jerome Powell came to the rescue with his sweet nothings. My colleague EJ Antoni broke it down, and it turns out that, like so much in the Biden era, the Blockbuster is hollow on the inside, amounting to a tissue fire as households spend down savings and the federal government takes over yet another slab of the real economy. In raw numbers, Q3 real GDP jumped 4.9%, which is a very high number, but we can run an easy check by looking at the key driver of economic growth, which is real private fixed investment, meaning factories and durable things that make us richer down the line. Turns out those have actually been flat for a year and a half. Oddly enough, right around when GDP numbers started saying the recession had already started. In fact, residential investment is below pre-pandemic levels, signaling the housing shortages will continue. So where did the GDP blockbuster come from? Three things: inventories, government spending, and unsustainable consumer spending. Taking each, inventory is companies stocking up to avoid future inflation, and it made up fully 27% of GDP growth this past quarter, which is a very high figure. Of course, it adds to today, but it subtracts from tomorrow. A second big hunk of blockbuster was government spending. Fully 1/5 of growth last quarter was in federal spending, which government statisticians obediently count as wealth creation since that's who pays their salaries. That would mark the fifth quarter now that federal spending is growing faster than the real economy, which pays for it. The rest of the blockbuster was consumer spending. Now, that's normally a very good thing, but the problem is that spending is rising even as incomes fall, meaning people are running down savings and raising household debt. In fact, real disposable income actually fell again last quarter, despite that 4.9 blockbuster, bringing it down 1.6 trillion since those halcyon days when Joe Biden first mounted the presidency. So in short, we are borrowing from tomorrow. We are condemning another hunk of the real economy to the black hole of government waste, even as Treasury pumps out $500 billion of fresh debt this month alone. That would be a $6 trillion annualized rate, which sounded goofy until very recently. All that federal spending, of course, will continue driving inflation for years to come. So what's next? Brought to you by Unchained. What's next is even the Fed doesn't seem to think this GDP number is real, given that just days later, Jerome Powell hinted that rate hikes will end, which is odd considering inflation has doubled since the previous GDP report and is now cruising close to 4% and rising. That's actually the optimistic read. The other possibility is the Fed knows it is backed into a corner, as soaring yields on the 10-year bonds suggest investors are getting very worried that maybe Uncle Sam won't repay its debts, which are apparently growing by several fresh-faced trillions each and every year. In short, we've got an economy running warp speed on debt, while the Fed runs for the hills despite soaring inflation, which is kind of its one job. Frustratingly, all of this has a very easy solution: slash federal spending, which would bring down inflation, it would lower interest rates, and it would return trillions to households and small businesses who earned it. Of course, that's the one thing Washington will never do. Okay, we'll be watching. See you next time.